What is happening, best ever community? This is Matt Faircloth, and I am your brand new host for the best ever CRE show. Now, you guys did not tune to the wrong podcast. You are not on the wrong channel. You are on the correct channel. This is the best ever CRE show, and I am your brand new host of the best ever CRE show that will be bringing out episodes to you guys every Friday. And how lucky am I to be here with you guys, to be talking real estate shop with you guys on a weekly basis. I cannot tell you how grateful I am. So stay tuned, buckle in, put your podcast seatbelt on, because we're going to be doing some phenomenal conversations every week here on the show when I am the host. Okay, best ever listeners, I've got a great guest for you guys, Arn Cenedella. Arn, how are you today?
Hey, Matt. Great to be here and looking forward to having a nice chat.
And I know you've done a lot of multifamily work, and also you've also done some build-to-rent stuff down there in Greenville as well, right? Yes. Let's talk real quickly on the build-to-rent side. Let's unpack that. What are you up to these days? How do those things shake out? Like for small BTR deals.
Yeah. So as many investors know, trying to buy existing assets in the last year or two have been very tough, right? So the delta between seller expectations and what buyers can pay given the debt, hard to bridge sometimes. So I kind of start to think, well, who's the most motivated seller in today's market? And I would say it's builders. Builders build to sell, to take their profit, and they move on to the next deal. They're typically not long-term buy and hold investors. So we started networking in the local real estate community here and have now worked with 3 different builders on smaller BTR projects. And we don't get involved with the ground up development, though at some point I may like to do that. We are buying these at CO, at Certificate of Occupancy. So basically, builder finds some land, gets it entitled, gets plans approved. We negotiate out a price, put down a deposit, and we close them when they're finished and signed off by the city or county.
Were on these deals, do you believe or do you know for a fact from hearing from them that these builders were intending to sell these units off to end home buyers, or were they always intending to lease them out?
I would say in some cases they were intending to sell them to retail buyers. Yes.
Yeah. Okay. Yes. And why? And so did they try and do it? It didn't work out, or they just kind of read that? It sounds like you're engaging with them while they're still mid-construction and working out a deal to buy them. So why are they pivoting? Do you think? I mean, I get, I could give you 30 guesses as to why they're pivoting, right? But like, what are they telling you, or what are you hearing why they're pivoting into selling to a, landlord buyer versus a homeowner buyer?
Yeah, a good question. And I would say if, you think about it, if you build 10 duplexes and you're going to sell them to 10 different retail buyers, you've got 10 escrows, 10 loan approvals. You're dealing with some maybe perhaps higher emotion with owner-occupied buyers. So we'll come along and go, hey, we'll buy all 10 as soon as they're done. And so from the builder's perspective, he's got a buyer for the entire project that will close 15 days after the units are completed. So I think that's an advantage to a builder. And for us, we actually like having control of the entire property, the entire development. We don't want to have a situation like where it's a fractured condo, where it's a 100-unit condo and you buy 30 units in it. That's a nightmare. And don't ever do that, please.
Yeah. I'm sure you've seen those marketed, right? Where it's like, hey, I got this condo project with 100 units in it, and I can sell you 30 of them.
Yes, run. Please do not make that mistake. Yeah. So, and what I would say is maybe we get them at a slight discount, not a huge discount. If they market them one by one, they're probably going to MLS, paying realtor commissions and so forth. So I think, basically with the builder, their construction loan is ticking every day till they get paid off. So if they have a buyer who can close right away, that limits the construction interest. And for us, we love buying new product as you know, much of the apartment stock in the Carolinas is built when in the 70s, 80s. It's now 40, 50 years old. And when you look at the price point, so like, for example, here in Greenville right now, say your typical 800 square foot 2-1 apartment unit built in 1980, probably costing you 110, 115 a door for 800 square foot, 50 years old. We're buying these new duplexes, 1,100 square foot, 2.5 for like 170 a door. So when you actually look at kind of a brick and mortar price or a price per square foot, the newer product, in my mind, just makes great sense. So we really like it. And then the other thing, when we go to exit 10 years from now, we still have new product as opposed to a product that's maybe 60 years old. And to be clear, I've got an offer on a 1969 building here in Greenville now too. So I'm not saying no to value add. I'm just saying there is some advantage to buying new construction. And of course, people love to rent houses that nobody's ever lived in before.
Well, let's compare the two, because I know you've done both, right? Compare for me some of the, maybe even benefit. You and I could do like a yeah, but back and forth, right? Because one's not better than another. It's just different, right? What's different in a 69, 70s, 71 build? C-class, everybody will call it C-class, right? C-class real estate versus a brand new build. Now that you've looked at both of them, and let's just start with underwriting. And underwriting the deal, what's different?
So for one, when you're buying new product, you don't have to estimate capex. And of course, as you get more professional, your estimates get better. But we also know when we budget capex, we probably put in a 10 or 15% contingency line item. Because no matter how well you inspect a building, almost invariably you're going to find one or two unknown issues. So
Sure.
Buying new product, you don't have to estimate capex.
Let me unpack that for a second for best ever.
Yeah,
best
sure.
ever listeners, what we're talking about here is capex on a 1969 build, right? That roof that you got sure may be in great condition, but it won't be for long, right? And at some point, you're going to start having some HVAC units die on you. And at some point, the windows that you got that were installed in, let's say 1986, are likely going to need to get replaced, right? So you're going to, if you're a smart operator, you're going to set aside some cash, or at least budget to set aside some cash during the hold cycle to take care of those kinds of things. So it's not value add, not a brand new kitchen that's going to get you more rent. These are just capex, or call them, you can call them, this is a nasty way to call it, deferred maintenance. It kind of sounds like, dealing with the skeletons that might be swept in the closet, and sometimes it is that. But it could be anything from cracked pipe that have just reaches the end of their useful life to, as I said, roofs, HVAC, windows, those kinds of things. And Arn, you're right. Brand new construction, that's brand new roof. You're likely, better be good to go for 30 years. Those are brand new HVAC units, and those are brand new windows. So if you do set aside for capex, not much. Got it. That's a huge difference.
Correct.
Keep going. What else? What else
Yeah.
do you see as a difference in underwriting?
Yeah, well, so on new construction, you have to kind of estimate some lease-up timetable, right? Say you buy something, 20 units, they're vacant. You have to estimate how many units you're going to rent per month and how long it's going to take you to get to kind of full occupancy or stabilization. And that's somewhat similar on a value add, where you understand you need to vacate a certain number of units to renovate them, and kind of what schedule you're going to do that on. Are you going to try to do 4 a month, 10 a month, 20 a month? So there's similarities there in terms of the rehab schedule versus the lease up till you get to stabilization. And then what else? I think the other thing is maybe they appeal to different investors. I think buying new product, it's going to maybe be a steady Eddie type investment, maybe not quite as high returns, but it's probably a little more secure, where with the value add, if it's done right and everything works, I think you have potential for higher return and profit
Over
on the
time.
deal
Yeah.
over time. But there's risk in implementation. And so each investor, I think, needs to kind of sort out where they are on that risk reward continuum. I tend to be kind of like a core plus investor. I like to kind of put my capital to work, good location, quality property, and just let time win the day for me, where I understand other people really like the value add and they do great at it and they can provide their investors excellent returns. It just kind of depends what you like.
Yeah. And I mean, I'll throw a few at you here, right? So obviously new construction, you're going to get higher rents because it's a higher quality product. It's a higher quality, it's just newer product, right? And it's built to today's standards. So you're likely going to be more generous kitchen finishes and generous square footages. And you're going to have cool stuff like, recessed lighting and ceiling fans and stuff like that you might not see in a 69, 70s vintage asset. So you're going to get higher rents. My bet is, Arn, I'm just going to bet you on this one. I don't know if I'm right or not. You tell me. Real estate taxes in dollars per door, I'd be willing to bet you will be less unless you've got some incentives or some tax abatements. But I'd be willing to bet you the real estate taxes will be lower on a 60s, 70s vintage. Am I right?
Yes, because the price per door is going to be less. And in South Carolina, it's a reassess upon sale state. So your property taxes are reassessed. So if you're paying $100 a door for existing product versus $170 a door for new build, yes, the property taxes per door will be higher on the new build. One of the benefits of the new build is typically they're all separately metered. So as an owner, you're not paying for water, sewer, and garbage, where typically in the older buildings you are. So we typically kind of model new construction maybe 40% OPEX ratio, maybe high 30s, because you don't have the maintenance, as much maintenance, and you're not paying utilities. Where on an older building, you can certainly get up to 50%.
Yeah, I had a few that we bought that were 65 when we bought them, And best over listeners, what we're talking about here is the ratio of the operating expenses to the rental income you bring in. So if I bring in $1 in rent on a older vintage property built in the 60s, 70s, I might pay 60 cents on that dollar to pay my operating expenses, my real estate taxes, insurance, maintenance, utilities, those kinds of things. And as Arn is saying, on a new construction asset, for every dollar I bring in rent, I'm only paying maybe 35 to 40 cents in operating expenses. Interesting. And just to unpack a few more, insurance is going to be more on an older build and less on a newer build, correct?
Yes.
Right. Which is interesting, by the way, because if a newer build burned to the ground, it would cost the insurance company more to rebuild that asset than it would be. But the probability of a new construction asset burning to the ground versus the probability of a 1960s asset burning to the ground is much higher on the older asset.
Correct. You got the older wiring. There's just a whole host of issues. With the modern construction, you get dual pane windows, you get insulation. Tenants love that. They're paying for heating and AC. So if you have an energy efficient building,
for fire, you might have a sprinkler system in place. For new construction, typically requires that too. So the probability of you burning to the ground if you get a sprinkler system in place, forget it. It's likely not going to happen.